How is private money lending different from hard money lending and conventional lending? So, with conventional lending, you typically have to apply as an individual unless you have a pretty big, successful, profitable business, in my experience. But you usually apply, they usually check your credit score and credit history, even if you are a company. There's usually like a cutoff or a threshold that they want to see. There is a calculation of debt to income ratio. Typically, they want to make sure that you can repay the amount that you take out. With conventional lending, it usually has to be secured by something. So that can be a house if you're in the real estate industry, it can be other assets. If it's like a personal loan, not so much. They don't always try to secure it with something. But they could try to secure it with a bank account or a brokerage account. Also, with conventional lending, typically there's a lengthy application process and you're having to put a lot of personal information. Sometimes you have to provide tax returns. It's pretty extensive. Then you have hard money lending. They don't typically lend to individuals. It's usually you have to have some sort of business entity. So that can be an LLC or a corporation. And they don't usually check your income, but they do typically ask for a credit score for the person who's going to be personally guaranteeing the loan. And that's not always required, but usually they want to know who's going to be personally responsible for this if something goes awry. And then with hard money lenders, there's still usually an application process. They usually secure the loan against some sort of real property or some other asset. The terms, when I first learned about hard money lending, I was taught that the terms are typically shorter, so like 1 year. But I've had hard money lenders give me, 30-year mortgages. So I think one of the biggest differences is it's just a little easier to get a hard money loan because a lot of times they're looking at liquidity and the actual transaction rather than your paycheck and using that as a way to determine your ability to pay. And it's just more expensive. So I think with that convenience and a more simple process for going with hard money, it costs more. So the interest rates are typically higher. There's usually more points that you have to pay. Sometimes there's a broker involved, but that could be on the conventional side as well. And then you have private money lending. So it can be as formal or informal as the lender wants it to be. For me, I don't have a formal application process for private money lending. I'm typically lending to someone I know or their company or someone they know. I'm looking at the specific use of the money. So sometimes I lend to people or companies in the construction space. So it might be a general contractor who has to work on a project and they need to pay their subcontractors, but they haven't yet received payment from maybe an insurance company or something. So sometimes they'll take out a private money loan so that they can make that payment. And then once they get paid, they'll pay back the private money loan. So sometimes those are the types of loans I give out. Or it'll be a flipper, someone who is flipping a property, they're an investor, maybe they acquired the property very cheap and they just need a loan for the rehab or the construction. And they're borrowing that money typically for 6 to 8 months. Whereas with the general contractor, they might only be borrowing it for 1 to 6 weeks. So it can be anywhere from 1 week, sometimes 1 day, to 6 to 8 months, even a year. It really just depends on whatever terms the private money lender and the borrower come up with. But it's very flexible, and depending on who the private money lender is, there may be an application, there may not. They may want to do a credit check, they may not. They may secure the loan with a lien on a property or some other, either real property or some other type of property, but they might not. So it's just very different. Honestly, it's like the wild, wild west out there. From a lender perspective, I'm pretty selective with who I let borrow money because I mean, I'm just a person. It's a little bit harder. I don't have the resources like a conventional bank does, or even a hard money lender does, to recover if a person doesn't pay on time or if they just don't pay at all. So I'm more selective with who I'm giving loans to. Um, the vetting is a little different. It might not be as thorough when you're doing private money. And to my knowledge, private money lenders aren't governed by the same lending laws that lending institutions are governed by. So if you can imagine, like, if you're lending money to just family members, I mean, technically you're a private money lender, especially if you're doing it on a regular basis. And you just because you're giving out those small loans randomly doesn't now make you a lender under the law in terms of being a lending institution. So it's definitely a bit different. Now, if you get to a certain volume of loans and a certain frequency, it may then put you in the realm of some of those laws. But we can talk about that another time. But for now, just keep in mind the private money lending process is typically less formal than with conventional or hard money loans. It can be very flexible. They may or may not want to look at your credit. They may not even secure the property. It just depends on the person's risk tolerance. And then when you have hard money and private money, it can be a lot more expensive than conventional loans, but a lot easier to get. So conventional loans, even though, you might have a 7% interest rate in buying a house, with a conventional loan, maybe a hard money lender will give you a 9 or 10% interest rate, but it's so much easier to get the hard money loan. And so sometimes that's why people will go that route. But also they may go the hard money route because they don't want the loan in their personal name. They don't want it to show up on their credit report. It's really their business that owns that property and has that debt. So there's ways to be strategic about it. Same thing with private money. Like, the private money lenders typically aren't reporting to any kind of credit agency, whether business or personal, but it depends. I don't personally report to any credit bureaus yet. It hasn't really come up. So it's a less formal process. Could be more expensive, but also could be better, could be more cost effective, especially as you build a relationship with your borrowers. You may be incentivized to give them better terms, but honestly, that's just up to you as the lender.